Good day everyone, and welcome to Synapse Global Institute. My name is Naomi, and I will be your lecturer for CPA Advanced Financial Management. I am delighted to have you in this class, and I encourage you to remain active throughout our sessions. Please feel free to use the chat section at any point to ask questions, seek clarification, or share your thoughts, because learning here at Synapse is interactive and student-centered. We begin with incorporating risk and uncertainty in capital investment decisions. In capital budgeting, firms are required to commit large sums of money today in anticipation of future benefits that are not guaranteed. Incorporating risk and uncertainty into capital investment decisions is therefore essential if companies are to make sound and informed choices about how they allocate their financial resources. Investment projects are rarely certain, and future cash flows can be affected by changes in market conditions, customer demand, costs, interest rates, regulations, and many other variables. By explicitly considering risk and uncertainty, firms reduce the likelihood of making poor investment decisions that could harm their long-term financial performance. As we go through this, please pause me through the chat if any concept feels unclear. Risk in capital budgeting refers to the possibility that actual outcomes will differ from what is expected. In practice, this is usually reflected in the variability of cash flows and profitability associated with a project. A project whose cash flows fluctuate widely from year to year is considered riskier than one with stable and predictable cash flows. Uncertainty, on the other hand, exists when the probabilities of different outcomes cannot be determined with precision. While risk allows us to estimate probabilities based on data or experience, uncertainty is more difficult to quantify because the information needed to assign probabilities is either incomplete or unavailable. It is important that you clearly distinguish between these two ideas, as they underpin all advanced capital budgeting techniques. There are several types of risk that affect capital investment decisions. Systematic risk is market-wide risk that affects all companies and cannot be eliminated through diversification. Examples include changes in interest rates, inflation, or economic recessions. Unsystematic risk is company-specific risk that arises from factors such as management decisions, operational inefficiencies, or labor issues, and this type of risk can be reduced through diversification. There is also project-specific risk, which relates to risks unique to a particular investment, such as technological failure, regulatory changes, or difficulties specific to the project's implementation. One key technique used to incorporate risk into capital investment decisions is expected monetary value. Expected monetary value is used to calculate the average outcome of an investment by weighting each possible outcome by its probability of occurrence. In words, expected monetary value is calculated as the probability of outcome 1 multiplied by the monetary value of outcome 1, plus the probability of outcome 2 multiplied by the monetary value of outcome 2, and so on for all possible outcomes. For example, suppose a project has a 50% chance of generating £100,000 and a 50% chance of generating £50,000. The expected monetary value is obtained by multiplying 0.5 by 100,000 and adding the result to 0.5 multiplied by 50,000, giving an expected monetary value of £75,000. This figure represents the average return the firm can expect if the project were undertaken many times under similar conditions. If you are unsure why we weight by probabilities, please ask in the chat and we will revisit it together. Risk is not only about expected returns but also about how much those returns can vary. Standard deviation and coefficient of variation are measures used to assess this variability. Standard deviation measures the spread of possible returns around the expected return and is calculated as the square root of the variance. A higher standard deviation indicates greater uncertainty because the outcomes are more widely dispersed around the expected value. The coefficient of variation expresses risk relative to return and is calculated by dividing the standard deviation by the expected return. This measure is particularly useful when comparing projects with different expected returns, as it shows the amount of risk per unit of return. To illustrate this, consider two projects. Project A has an expected return of £200,000 with a risk level of 20%, while Project B has an expected return of £250,000 with a risk level of 40%. The coefficient of variation for Project A is calculated by dividing 20% by 200,000, giving 0.1 or 10%. The coefficient of variation for Project B is calculated by dividing 40% by 250,000, giving 0.16 or 16%. Since Project A has the lower coefficient of variation, it is relatively less risky per unit of return. If this comparison feels abstract, pause and ask yourself which project gives you more stability for each pound expected, and feel free to raise questions in the chat. Another approach to incorporating risk is the risk-adjusted discount rate. Under this method, the discount rate used in net present value calculations is increased to reflect the level of risk associated with a project. Riskier projects are assigned higher discount rates, while safer projects are discounted at lower rates. In words, the risk-adjusted discount rate is calculated as the base discount rate plus a risk premium. For example, if a project has a base discount rate of 10% and a risk premium of 5%, the risk-adjusted discount rate becomes 15%. This higher rate reduces the present value of future cash flows, reflecting the higher uncertainty involved. The certainty equivalent method takes a different approach by adjusting the cash flows themselves rather than the discount rate. Under this method, risky future cash flows are converted into equivalent certain amounts using a certainty equivalent factor, and these adjusted cash flows are then discounted at the risk-free rate. In words, the certainty equivalent is calculated as the cash flow multiplied by 1 minus the risk factor. For example, if a future cash flow of £100,000 is considered to have a risk level of 20%, the certainty equivalent is calculated by multiplying 100,000 by 1 minus 0.2, resulting in £80,000. This adjusted amount represents the level of certain cash flow the decision-maker considers equivalent to the risky cash flow. Let us now apply these ideas using a practical example. Consider a project with 3 possible outcomes. The first outcome is a profit of £50,000 with a probability of 0.3. The second outcome is a profit of £100,000 with a probability of 0.5. The third outcome is a profit of £150,000 with a probability of 0.2. The expected monetary value is calculated by multiplying 0.3 by 50,000, adding 0.5 multiplied by 100,000, and adding 0.2 multiplied by 150,000. This gives 15,000 plus 50,000 plus 30,000, resulting in an expected monetary value of £95,000. To measure risk, we calculate the standard deviation. First, we find the deviations of each outcome from the expected return of £100,000. For the first outcome, 50,000 minus 100,000 gives a negative 50,000. For the second outcome, 100,000 minus 100,000 gives 0. For the third outcome, 150,000 minus 100,000 gives 50,000. These deviations are then squared and multiplied by their respective probabilities. 0.3 multiplied by 50,000 squared gives 7,500,000,000, 0.5 multiplied by 0 squared gives 0, and 0.2 multiplied by 50,000 squared gives 5 billion. Adding these gives a variance of 12,500,000,000. The standard deviation is the square root of this variance, which is approximately £111,803. The coefficient of variation is then calculated by dividing the standard deviation by the expected return of £100,000, giving approximately 1.12. This indicates a high level of risk relative to the expected return. As we work through these numerical examples, I encourage you to use Synapse Flexible Model to pause and chat if you want any step repeated or explained differently. These calculations are central to examination success and professional application. We now move into techniques of handling risk using basic methods of analysis, specifically expected monetary value, the standard deviation, and the coefficient of variation. These techniques are fundamental in capital budgeting because they provide structured ways of measuring and comparing risk. When future outcomes are uncertain, please remember to use the chat section at any point if you need clarification, as these methods form the foundation for more advanced risk analysis later in the syllabus. Expected monetary value, commonly referred to as EMV, is a decision-making tool used to evaluate risky projects by calculating the average monetary outcome, taking into account all possible scenarios and their associated probabilities. The purpose of EMV is to summarize uncertain future outcomes into a single expected figure that reflects both the size of possible payoffs and the likelihood of their occurrence. In words, expected monetary value is calculated as the sum of the probability of each outcome multiplied by the monetary value of that outcome. This means we take each possible result, weight it by how likely it is to occur, and then add all those weighted values together. EMV therefore represents the long-run average outcome if the same decision were repeated many times under identical conditions. To illustrate this, consider a project with 3 possible outcomes. The first outcome is a profit of £30,000 with a probability of 0.4. The second outcome is a profit of £50,000 with a probability of 0.5. The third outcome is a profit of £70,000 with a probability of 0.1. The expected monetary value is obtained by multiplying 0.4 by 30,000, adding the result to 0.5 multiplied by 50,000, and then adding 0.1 multiplied by 70,000. This gives 12,000 plus 25,000 plus 7,000, resulting in an expected monetary value of £44,000. This tells us that, on average, the project is expected to yield a profit of £44,000 when all possible outcomes and their probabilities are considered. If this interpretation is not yet clear, please pause me through the chat so we can walk through it again slowly. While EMV provides information about the average expected return, it does not tell us anything about the risk or variability of those returns. This is where the standard deviation becomes important. The standard deviation is a statistical measure that shows how much the possible returns from a project are spread out around the expected value. In capital budgeting, it is used as a measure of risk. A higher standard deviation indicates greater risk because the project's returns are more widely dispersed from the expected return. In words, the standard deviation is calculated as the square root of the sum of each probability multiplied by the squared difference between the outcome value and the expected value. Using the earlier example with an expected monetary value of £44,000, we first calculate the deviations from the expected value. For the first outcome, 30,000 minus 44,000 gives a negative 14,000. For the second outcome, 50,000 minus 44,000 gives 6,000. For the third outcome, 70,000 minus 44,000 gives 26,000. Each of these deviations is then squared and multiplied by its respective probability. 0.4 multiplied by 14,000 squared gives 78,400,000. 0.5 multiplied by 6,000 squared gives 18 million, and 0.1 multiplied by 26,000 squared gives 67,600,000. Adding these gives 164 million. The standard deviation is the square root of this figure, which is approximately £12,809. This value represents the degree to which actual returns are likely to differ from the expected return of £44,000. If you are wondering why we square and then take the square root, feel free to raise that question in the chat. Although the standard deviation is useful, it can be misleading when comparing projects with different expected returns. This limitation is addressed by the coefficient of variation. The coefficient of variation is a relative measure of risk that expresses the standard deviation as a proportion of the expected return. In words, the coefficient of variation is calculated as the standard deviation divided by the expected value. This measure allows us to compare the riskiness of projects on a like-for-like basis, even when their expected returns differ. A lower coefficient of variation indicates less risk per unit of return, while a higher coefficient of variation indicates more risk per unit of return. Continuing with our example, the standard deviation is approximately £12,809, and the expected monetary value is £44,000. The coefficient of variation is therefore calculated by dividing 12,809 by 44,000, giving approximately 0.29. This means that for every £1 of expected return, there is a risk of about 29 pence. This relative measure of risk is especially useful when management must choose between competing projects with different scales of investment and different expected returns. Let us now apply these ideas using a practice question. A company is considering a project with three possible outcomes: a profit of £40,000 with a probability of 0.2, a profit of £60,000 with a probability of 0.5, and a profit of £80,000 with a probability of 0.3. The expected monetary value is calculated by multiplying 0.2 by 40,000, 0.5 by 60,000, and 0.3 by 80,000, then adding the results together. This gives 8,000 plus 30,000 plus 24,000, resulting in an expected monetary value of £62,000. To calculate the standard deviation, we first determine the deviations from the expected value of £62,000. 40,000 minus 62,000 gives a negative 22,000, 60,000 minus 62,000 gives a negative 2,000, and 80,000 minus 62,000 gives 18,000. Each deviation is squared and multiplied by its probability. 0.2 multiplied by 22,000 squared gives 96,800,000, 0.5 multiplied by 2,000 squared gives 2 million, and 0.3 multiplied by 18,000 squared gives 97,200,000. Adding these results gives a variance of 196 million. The square root of this variance gives a standard deviation of approximately £14,000. The coefficient of variation is then calculated by dividing 14,000 by 62,000, giving approximately 0.226. These calculations demonstrate how expected monetary value, standard deviation, and coefficient of variation work together to provide a fuller picture of both return and risk in investment decision-making. As you revise this section, focus not only on how to perform the calculations but also on how to interpret the results in a decision-making context. Please use the chat section if any part of this analysis is unclear or if you would like to attempt additional examples together. Let's now look at advanced methods of analysis used to incorporate risk and uncertainty into capital investment decisions. These methods build on the basic techniques we have already covered and are particularly useful where projects are complex, outcomes are uncertain, and management needs a deeper understanding of how risk affects value. As we go along, I encourage you to use the chat section to ask questions or request clarification, especially where the methods appear similar but serve different decision-making purposes. We begin with sensitivity analysis. Sensitivity analysis is used to examine how sensitive the outcome of an investment appraisal, such as net present value or internal rate of return, is to changes in one key variable at a time. The idea is to isolate a single factor, such as sales volume, selling price, operating costs, or the discount rate, and then assess how changes in that factor affect the project's results, while all other variables are held constant. This method helps management identify which assumptions are critical to the success of the project and where the greatest risk lies. For example, if a project has an expected net present value of £100,000, sensitivity analysis may involve increasing sales by 10% and observing that the net present value rises to £120,000, or decreasing sales by 10% and observing that the net present value falls to £80,000. This analysis shows how vulnerable the project is to changes in sales and highlights areas that require careful forecasting and control. If at any point you are unsure why only one variable is changed at a time, please raise that in the chat. Closely related, but more comprehensive, is scenario analysis. Scenario analysis considers the combined effect of changes in several variables at the same time. Instead of changing one factor in isolation, this method constructs a set of possible future scenarios that reflect different states of the world. Typically, these include a best case scenario, a worst case scenario, and a most likely scenario. Each scenario involves simultaneous changes in key variables such as sales volume, cost of goods sold, and tax rates. For instance, under a best-case scenario, sales may increase by 20%, costs may fall by 10%, and tax rates may decrease by 5%. Under a worst-case scenario, sales may decrease by 10%, costs may increase by 15%, and tax rates may rise by 10%. The most likely scenario assumes that conditions remain as expected. The net present value is calculated for each scenario, allowing management to assess whether the project remains acceptable under adverse conditions. Scenario analysis therefore provides a broader view of risk than sensitivity analysis and is particularly useful where variables are interrelated. Another powerful technique for analyzing risk is the use of decision trees. Decision trees provide a visual and analytical representation of sequential decisions and uncertain outcomes over time. They are especially useful where investment decisions occur in stages and where future decisions depend on earlier outcomes. A decision tree sets out decision points, possible outcomes, associated probabilities, and monetary payoffs. For example, a company may invest £100,000 in a project. If the project is successful, with a probability of 70%, it yields a payoff of £200,000. If it fails, with a probability of 30%, the payoff is zero. The expected monetary value of each branch is calculated by multiplying each payoff by its probability, and the decision that yields the highest expected monetary value is selected. Decision trees help managers visualize risk, structure complex decisions logically, and incorporate both probability and timing into investment appraisal. If you find decision trees difficult to follow at first, that is completely normal, and we can work through them step by step together using the chat. We now move to simulation analysis, which is used where projects involve many uncertain variables that interact with one another. Simulation analysis relies on computer-based models to generate a large number of possible outcomes by repeatedly sampling random values for key inputs. The most common form is Monte Carlo simulation. In this approach, variables such as sales, costs, and discount rates are assigned probability distributions rather than single values. The model is then run many times, for example 1,000 iterations, to produce a distribution of possible net present values. This allows management to estimate the probability that a project will achieve a certain level of return or suffer a loss. Simulation analysis is particularly useful where traditional analytical methods become too complex, and it provides a richer understanding of risk by showing the full range and likelihood of possible outcomes. Another advanced approach is utility analysis. Utility analysis recognizes that decision-makers do not always behave as if they are only concerned with maximizing expected monetary value. Instead, individuals may be risk-averse, risk-neutral, or risk-seeking, depending on their preferences. Utility analysis incorporates these preferences by measuring satisfaction or utility rather than monetary value alone. Under utility theory, decision-makers choose the option that maximizes their expected utility rather than their expected monetary return. For example, if two projects have the same expected net present value, but one project involves significantly higher risk, a risk-averse manager may prefer the less risky project, even if its expected return is slightly lower. Utility analysis therefore explains why different managers may make different decisions when faced with the same investment information. We now revisit the risk-adjusted discount rate, but at a more advanced level. The risk-adjusted discount rate method incorporates risk by adjusting the discount rate used in net present value calculations. Riskier projects are discounted at higher rates to reflect greater uncertainty, while less risky projects use lower discount rates. In words, the risk-adjusted discount rate is calculated as the risk-free rate plus a risk premium. The risk-free rate represents the return on a risk-free investment such as government bonds, while the risk premium compensates investors for bearing additional risk. For example, if the risk-free rate is 5% and the project-specific risk premium is 3%, the risk-adjusted discount rate is 8%. This adjusted rate is then used to discount the project's future cash flows. While this method is simple and widely used, it assumes that risk increases uniformly over time, which may not always be realistic. If you are uncertain about when this method is appropriate, please raise that point in the chat. Finally, we consider the certainty equivalent method. This method addresses some of the limitations of risk-adjusted discounting by adjusting cash flows rather than the discount rate. Under the certainty equivalent approach, each risky future cash flow is converted into a certain equivalent amount that reflects the decision-maker's assessment of risk. These certainty equivalent cash flows are then discounted at the risk-free rate. In words, the certainty equivalent is calculated as the risky cash flow multiplied by 1 minus the risk adjustment factor. For example, if a project has an expected cash flow of £100,000 in Year 1 and the perceived risk is 20%, the certainty equivalent is calculated by multiplying 100,000 by 1 minus 0.2, giving £80,000. This adjusted cash flow is then discounted at the risk-free rate. The certainty equivalent method is particularly useful where risk varies significantly over time and where management wishes to treat risk in a more explicit and transparent way. In summary, advanced methods of risk analysis allow managers to move beyond simple averages and examine how uncertainty affects investment outcomes in a more realistic and informative manner. Sensitivity analysis focuses on individual variables, scenario analysis considers combined changes, decision trees structure sequential decisions, simulation analysis models. Complex uncertainty, utility analysis incorporates risk preferences, and both the risk-adjusted discount rate and certainty equivalent methods integrate risk directly into valuation. Please take a moment to reflect on how these methods differ, and use the chat section to ask questions before we proceed further. Let's now examine the impact of financing on investment decisions, with particular focus on the concept of adjusted present value, commonly referred to as APV. This is an important area because it allows us to separate investment decisions from financing decisions and understand clearly how financing choices add to, or sometimes reduce, the overall value of a project. Please feel free to use the chat section at any point if you need clarification, especially as this topic links directly to both capital budgeting and financing strategy. Adjusted present value is a capital budgeting technique used to evaluate investment projects by first considering the value of the project as if it were financed entirely by equity, and then separately adding the value of financing effects such as tax benefits arising from debt. The core idea behind APV is that the decision to invest in a project and the decision on how to finance that project are conceptually distinct, and therefore should be analyzed separately. Traditional methods such as net present value often combine these effects into a single discount rate, which can obscure the true contribution of financing to project value, particularly where projects involve significant debt financing. Under the APV approach, the value of a project is calculated in two main stages. The first stage involves calculating the base case net present value, also referred to as the unleveraged net present value. This represents the value of the project assuming it is financed entirely with equity, with no debt involved. The second stage involves calculating the value of financing effects, most commonly the tax shield that arises because interest payments on debt are tax deductible. The adjusted present value is then obtained by adding the value of these financing effects to the unleveraged net present value. Adjusted present value is calculated as the net present value of the project assuming all equity financing plus the net present value of financing benefits. The unleveraged net present value is calculated by discounting the expected project cash flows at the cost of equity, which reflects the risk of the project itself without considering any financing effects. This step ensures that the project's operational performance is evaluated independently of how it is financed. To calculate the unleveraged net present value, each year's cash flow is discounted using the cost of equity. For example, if a project generates equal annual cash flows over several years, each of those cash flows is divided by 1 plus the cost of equity raised to the power of the relevant time period, and the resulting present values are added together. This gives the total present value of operating cash flows, which represents the project's value on an all-equity basis. If you are unsure why we use the cost of equity here and not a weighted average cost of capital, please ask in the chat, as this distinction is critical to understanding APV. The second stage involves identifying and valuing financing effects. The most common financing benefit is the tax shield on debt. A tax shield arises because interest payments reduce taxable profits, leading to tax savings for the company. In words, the tax shield is calculated as the amount of debt multiplied by the corporate tax rate. Where interest payments occur annually, The tax shield also arises annually and must be discounted to present value. Because the tax shield is linked directly to debt, it is normally discounted at the cost of debt. For example, if a company finances part of a project with £500,000 of debt at an interest rate of 5%, the annual interest payment is £25,000. If the corporate tax rate is 30%, the annual tax shield is calculated by multiplying 25,000 by 30%, giving £7,500 per year. To find the present value of this tax shield, each year's tax saving is discounted at the cost of debt, and the discounted values are added together. Once the unleveraged net present value and the present value of the tax shield have been calculated, the adjusted present value is obtained by adding the two figures together. This final value represents the total value of the project, taking into account both its operating performance and the benefits arising from its financing structure. A positive adjusted present value indicates that the project adds value to the firm after considering financing effects. To illustrate this concept, consider a project with an initial investment of £1 million that generates cash flows of £300,000 per year for 5 years. If the cost of equity is 10%, the unleveraged net present value is calculated by discounting each of the annual cash flows at 10% and summing the results. This produces a total present value of £1,137,243. This figure reflects the value of the project assuming it is financed entirely with equity. Suppose now that half of the project is financed with debt of £500,000 at an interest rate of 5% and the corporate tax rate is 30%. The annual interest payment is £25,000 and the annual tax shield is £7,500. Discounting these tax shields at the cost of debt over 5 years gives a present value of £32,484. The adjusted present value is then calculated by adding the unleveraged net present value of £1,137,243 to the present value of the tax shield, giving a total adjusted present value of £1,169,727. This result shows clearly how financing decisions add value to the project through tax savings. By separating operating value from financing effects, APV allows managers to see exactly where value is created. This makes APV particularly useful for projects with complex or changing financing structures, such as leveraged buyouts, projects with high levels of debt, or situations where financing arrangements differ significantly from the firm's normal capital structure. One of the key advantages of using adjusted present value is this clear separation between investment and financing decisions. It also offers flexibility, as different financing components such as tax shields, subsidies, or issuance costs can be valued separately and added to the base project value. As a result, APV often provides greater transparency than traditional net present value methods in complex financing situations. Before we move on, I encourage you to pause and reflect on why APV can be more informative than a single discounted cash flow calculation when financing plays a major role. Please use the chat section to ask any questions or request further clarification. Let's now move into incorporating capital rationing in capital investment appraisal. This topic is particularly important in practice because firms often face limitations on the amount of capital available for investment, even when several profitable projects exist. As always, please use the chat section freely if you need clarification, as capital rationing brings together many ideas we have already covered in capital budgeting. Capital rationing refers to a situation in which a firm has a limited amount of capital available for investment and therefore cannot undertake all projects that have a positive net present value. In such circumstances, management must decide how best to allocate the scarce capital among competing investment opportunities. The objective under capital rationing is not simply to accept all profitable projects, but rather to maximize the overall return generated from the limited funds available. Capital rationing forces decision-makers to prioritize projects and select those that offer the greatest benefit relative to their cost. There are two main forms of capital rationing relevant to our discussion: single-period capital rationing with divisible projects and multi-period capital rationing with divisible capital investments. Both cases assume that projects are divisible, meaning that the firm does not necessarily have to commit the full investment amount at once but can invest in fractions or phases of a project. We begin with single-period capital rationing with divisible projects. In this situation, the firm has a fixed amount of capital available for investment in a single period, such as one financial year. Multiple projects may be available, but the total investment undertaken must not exceed the capital budget for that period. Because projects are divisible, the firm can choose to invest partially in a project rather than committing to it in full. The key tool used under single-period capital rationing is the profitability index. The profitability index measures the return generated per unit of capital invested and is therefore particularly useful when capital is scarce. In words, the profitability index is calculated as the net present value of a project divided by its initial investment. Projects with a higher profitability index generate more value per pound invested and should therefore be given priority. The process of allocating capital under single-period capital rationing involves several steps. First, all available projects are identified and evaluated using an appropriate appraisal method such as net present value. Second, the profitability index for each project is calculated. Third, the projects are ranked in descending order of profitability index, with the highest ranked projects offering the greatest return per unit of capital. Finally, capital is allocated starting with the highest ranked project and moving down the list until the available capital is fully utilized. Because projects are divisible, the firm may invest only part of the required amount in the final project if the remaining capital is insufficient to fund it fully. To illustrate this, consider a company with £1 million available for investment in the current period. Suppose 4 projects are available. Project A requires £500,000 and has a net present value of £200,000, giving a profitability index of 0.4. Project B requires £600,000 and has a net present value of £150,000, giving a profitability index of 0.25. Project C requires £200,000 and has a net present value of £100,000, giving a profitability index of 0.5. Project D requires £300,000 and has a net present value of £120,000, giving a profitability index of 0.4. Ranking these projects by profitability index places Project C first, followed by Projects A and D, and finally Project B. The firm would first invest £200,000 in Project C, leaving £800,000. It would then invest £500,000 in Project A, leaving £300,000. With the remaining capital, the firm can invest in Project D, which requires exactly £300,000. In this way, Projects C, A, and D are selected, and the firm maximizes the value generated from its £1 million capital constraint. If at any point this ranking process feels confusing, please ask in the chat and we will work through it again together. We now turn to multi-period capital rationing with divisible capital investments. In this case, the firm faces capital constraints over several periods rather than in a single period. The company must therefore decide not only which projects to undertake, but also when to undertake them, taking into account the availability of capital in each period. This situation is common in long-term strategic planning, where investment funds are released gradually over time. As with single-period rationing, projects are assumed to be divisible, allowing investments to be phased over multiple periods. The allocation process begins by identifying all available projects in each period, along with their investment requirements, expected returns, and net present values. Projects are then ranked using the profitability index or a similar measure of relative attractiveness. Capital is allocated to projects in order of priority, subject to the capital available in each period. For example, consider a firm with available capital of £1 million in year 1, £500,000 in year 2, and £200,000 in year 3. In year 1, the firm selects projects with the highest profitability indexes until the £1 million limit is reached. Any remaining capital can be carried forward to the next period. In year 2, the firm adds the new capital available to any unused capital from year 1 and again allocates funds to the most attractive projects available in that period. This process continues into year 3, ensuring that the total investment in each year does not exceed the capital available for that year. To illustrate, suppose that in year 1 the firm selects 2 projects costing a total of £700,000, leaving £300,000 unused. In year 2, this £300,000 is added to the £500,000 available for that year, giving a total of £800,000 to allocate. The firm then selects the highest ranked projects available in year 2 within this limit. If no further capital is available in year 3, no new projects can be started, and the firm proceeds with the investments already undertaken. In this way, the firm maximizes overall returns across multiple periods while respecting capital constraints in each period. In summary, capital rationing arises when investment funds are limited and requires firms to prioritize projects carefully. Single-period capital rationing focuses on allocating a fixed budget within one period, while multi-period capital rationing extends this decision-making across several periods. In both cases, the profitability index plays a central role by helping managers identify which projects generate the greatest value per unit of capital. Understanding these techniques is essential, as capital rationing is a realistic constraint faced by many organizations. As we bring this session to a close, I encourage you to reflect carefully on how capital rationing reshapes investment decision-making when funds are limited, and why techniques such as the profitability index become critical in prioritizing projects. These ideas are highly examinable and equally important in real-world financial management, where capital constraints are the norm rather than the exception. Please take a moment to note any areas that require further clarification and feel free to raise them in the chat.